What not to do before buying a home. Avoid losing your pre-approval or avoid not getting qualified from the beginning. What not to do before buying a home. Let me tell you something. I've seen buyers lose their homes days before closing. Not because they couldn't afford it, but because of small mistakes that they didn't even know mattered. Today, I'm going to share the top mistakes you must avoid before buying a home. Hi everyone, my name is Elsa Brunache. I am a loan officer here in Florida, and I help individuals and families get approved and into their homes the right way. If you're thinking about buying a home this year, you definitely need to hear this. Number one mistake to avoid: opening new credit cards or loans. Before you start the home buying process, or if you're in the home buying process, opening new credit cards or applying for loans could possibly be detrimental to your home buying efforts. Now, does that mean you're not going to qualify? Not necessarily, but depending on the credit card that you open, the loans, that might affect you, and it may have a negative impact on your pre-approval. Okay, a lot of people think, let me build my credit real quick. So they go and they open a new credit card. Well, that may not always be the right option. And that's why when I sit with my clients, I always give you what is going to be the best thing for you. Now, one of the key things I tell people, it is better, in my opinion, it is better for you to have no credit at all than obviously to have bad credit. Why? When you have no credit at all, it's a lot easier for you to build your credit versus when you have bad credit. Now it's like you're starting from negative and trying to work your way up to zero and then to work your way up. If you have no credit, that means you're starting from zero and it can only go up from there, right? So that's why I always encourage you, if you have no credit, don't be discouraged. I can actually help you and we can come up with a plan that could be a right fit for you and your family, so that way you can start your home buying process. Okay. So now, when you want to open a credit, right? Because you think, well, that's going to help you. Before you do that, talk to a professional, talk to a loan officer first, call me, talk to me first. That way we can see what is the right thing for you. You may think that you don't have credit, and maybe you do. Or you may think that your credit is not worthy enough or you don't qualify. Well, it's possible that you do. I have many clients that thought that they did not have the right credit, thought that the credit was not high enough to qualify, and they were able to qualify and get into their home. So, why am I saying that? Because a lot of times people don't know, and they make decisions based on not even knowing all the full information that pertains to them and their needs. And that's why I think it's so important that you sit down and you do a consultation that revolves around your specific information. Not what you heard someone was talking about or what they may have said, but what pertains to you. For example, we'll do the application. I will review your credit history. I will review your work history, and we'll talk about these things. I will show you if there's things that needs to be improved, what you need to do. That way, it's easier for you to be able to get to the process or get to the point that you are able to buy. I have clients, we do the pre-approval, I go through the process, right away they qualify. That's great news. And that could be you too. You never know. And that's why I tell you, reach out to me. Don't be afraid. Even if you think, oh my gosh, my credit is so awful, that's okay. Let's talk about it. Let's talk about it. Let's see, what can work for you, right? So, the second mistakes that people often do is financing furniture or car before closing. Please avoid that at all costs. Do not finance anything Anything that you did not finance prior to getting pre-approved, do not. I know sometimes it's very tempting. You go to the mall, you go shopping, and they say, hey, for 10%, 15% off, just get a new credit card. That can be very tempting. But that 10% or 15% could possibly cost you a lot more in the long run. And that's why I always tell people, nope, I have enough credit cards. Nope, even if you don't, nope, I have enough credit cards. Why? Because that 10% or 15% or even 20% off on a $100 item could end up costing you more, hundreds or thousands more down the line, depending on how it affects your credit. So that's why it's always important to try your hardest. Try your hardest, especially if you are in a home buying process. If you're thinking of getting in the home buying process pretty soon, try your hardest to try to avoid getting into, credit card or other loan debt. Now, buying a car, that one is a big one. I have many people that I've sat down with, and because of a car payment that they have, now that makes it difficult for them to qualify or maybe qualify for the amount of money that they would like to purchase. So that's why it's very important, please, if you do not own your own home yet, try your hardest to not finance a car. Let me repeat. If you do not own your own home yet, right? If you are paying someone else's mortgage, please try very hard to not finance a car. Why? Because that debt right now, once you finance, will be added to your debt to income ratio, and that could potentially make it harder for you to either qualify or qualify for the amount of money that you would like to be approved to purchase the home that you want. So that's why I tell people, if you do not own your own home yet, or you may own your own home and maybe you're thinking of either refinancing or you're thinking of buying another home, try to do that before buying a car or any large furniture item or any large items that will be on your credit. Now, if you want to buy a car cash, please go ahead. Handle your business, right? But if you're going to finance, maybe it's best that you sit with someone. Let's talk. Let's sit down together. Let's come up with a plan to see what that potential payment could look like and how that could affect your ability to be able to afford to buy the home that you want. Now, buying a car does not necessarily mean that you don't qualify, but maybe it might be the difference between you qualifying for a $400,000 home and, to a $350,000 home, whatever that number may be, right? So that's why it's very important that you decide first, let's sit down with someone that can, advise you on the option that could be best for you, especially if you're thinking about buying a car. Now, the other great thing or big thing that could possibly affect you, right? Another third mistake, missing or being late on payments. Oh, that one I feel like should be number one. Missing or being late on payments. If you're going through hard times, things happen, life happens. What I would advise you, the best option that you can do for yourself is at least try to do the minimum payments. The minimum payments on your credit cards, on student loan, on car payments, whatever debt that you have, whatever that minimum payment is required for you to show on-time payments, please do that. That's going to be something that's going to help you in so many ways in the short term and in the long term, right? Because as I've said before, whether you're using me, who's a broker, and I work with different banks to find the best option for you, or you're going to whatever institution that you're choosing to go to, the only way that you can truly be judged is through your credit, right? Through your credit report. That's the only thing that, everybody basically, once you give permission, obviously, will have access to the same information, which is your credit report. So now, anytime that you're late, that has a huge impact on your credit score. That has a huge impact on your credit report. The more often you're late within a year, 2 year period, that also has an impact on your buying power. Okay, the every single time that you make a late payment, and when I say late, is basically if your credit card payment is due on the 10th of every month, right? Right now, let's say we're in April and your next payment is due May 10th. So if you waited, let's say you didn't pay April's payment, and now you have May 10th coming up. The moment that you allow the other month to come, you're basically late, and that will be more than likely reported on your credit. And when that happens, okay, that negatively impacts your score. So that's why I tell people, please do the very best that you can to at least do the minimum payments. If the minimum payment is $20, $30, $100, it depends obviously based on the amount of money that you borrow. Do the minimum. Do at least the minimum. If you can pay it off, even better, but at least do the minimum. Why? Because then it's going to show that you have a positive payment history. I mean, let's think about it, right? You're trying to buy a home, $400,000, $500,000 home, right? Or 200 or 350, whatever it may be. $1 million. I mean, hey, I can help you with all of those. You're trying to buy a home, and yet you don't have the cash. Most of us do not have the cash to buy it outright. So we have to use the bank. We have to finance. We can use, broker like myself or whatever choice that you want to make. I would prefer to use me, obviously. So now, when we pull your credit, right, the initial process with me is obviously we have a sit down, we do a consultation, you do the application, I pull credit, I get your income documentation, and we go over the different options, right? So once that happens, then once I say that, hey, you're pre-approved for 400,000, for 500,000, for 600,000, whatever it may be, then that pre-approval you can use to go and shop for the house that you want. But a lot of times people, the mistake that a lot of people make is because they were consistently late, right? Whether they were late on credit cards or they were late on their car note, or maybe they had a home that they were late on, or they were late on student loan debt, right? Now that starts counting against you. So from the bank's perspective, right, if you're late on a maybe $50 $50 credit card payment, or maybe a $400 car payment, why would I give you a mortgage, where it's going to be like $3,000 for the month? Right? Like if you're not showing that you can be responsible, right, to make a minimum of $100 a month credit card payment, or $300 a month car payment, or 400, whatever it may be, right? Now you're basically telling the bank, hey, I need you to trust me. Okay, I'm going to pay you. I'm going to pay you on time. I need you to trust me with your $2,500 a month, mortgage, or $3,000 a month mortgage, or $3,500 a month mortgage. I need you to trust me. But then it's like, well, okay, if you're late maybe once, maybe twice, within a year, okay, maybe. But if you're late every single month, then we have a problem. And when I say we have a problem, I don't have any problems, but that could potentially have a very negative impact on you and your ability to qualify for more money, your ability to qualify. So that's why I encourage you, do at least the minimum, whatever that bare minimum, that when you receive the statements, especially your credit cards, that you receive the statement that says, minimum payment due is $50, $30, $100, $200, whatever that minimum is, let's do it and do it on time. So that way You're showing the bank, hey, I am responsible. I have shown responsibility when it comes to paying the credit cards, which may not be that much, or maybe I have some student loans. I have shown responsibility of paying them on time if you're not in deferment, or your car payment, or whatever other debt. Maybe you bought a furniture and you got that on credit, whatever it may be. You're showing that you are responsible for the lower payments. Then it's a lot easier based on your credit history for an institution to trust that you will be responsible and will be paying on time for your mortgage as well. So that's why I tell people it is crucial that you maintain your minimum payment. You try to stay under a certain utilization amount, and you try to obviously not max your credit card and all the different things that could potentially not put you in a very good place when it comes to being able to buy your home. Now, if you have late payments, does that mean you can't buy? Not necessarily. I have clients that have late payments, and it could be maybe it was like 1 or 2 late payment in the year, depending on how many times they were late. But their credit score is still really good. They didn't have any other really negative items on their credit that they're able to move forward. But each case is different. So that's why I tell people I can only advise you based on your particular information, your specific information. You can tell me, well, someone else had a bad X, Y, and Z and they bought. That's great for them. But unless I have that specific information of what they had, then it's very hard for me to advise on that. But when it comes to you, you do the application, you submit your documents, and I have the full picture in front of me, then we can sit down and do a breakdown, and I can definitely help you when it comes to what you will need to be able to qualify and get into your home. Now, the other mistake, and a lot of times people don't realize it's a mistake until it's a little too late, right? Changing jobs. Okay, especially changing jobs without talking to your loan officer, which is me, without talking to me, right? Changing jobs. Now, changing jobs may not necessarily be a bad thing, okay? But sometimes people think, I got a better opportunity. Let me switch jobs real quick. Okay. There are some factors that it's important for you to consider before you do that. Like I've had clients who come to me and say, hey, I currently work here, but I would like to maybe switch jobs and work for a different company. They're going to pay me X, Y, and Z and all that. We sit down, and I analyze, and I tell them, well, okay, well, you know what? If that's going to give you a better opportunity and you're not looking to buy right away anyways, then that may make sense, right? But then there are some clients who's like, oh, I went from working W-2, right? I was working for someone. They were paying me a consistent paycheck every week or every other week. And now I want to have my own business. Yay! Congratulations. I'm happy for you. I really am. But, I want to have my own business, but my lease is going to be up in a few months, and I would like to have my own home by then. Yeah, now things become a little bit more complicated, right? Because switching jobs is not necessarily a bad thing, but obviously the more stable you are in a company, in the industry, the better it is for you. But what could happen as well is even if you go, and I've said that, even if you go from, let's say, for example, I had this poster for a doctor, but you can fill in the blank, right? But let's say you are in the medical profession and you were working at, institution, a hospital, nursing home, whatever it may be, right? But you were considered an employee, so you were working for that company, right, as an employee. They're the one who pay taxes, who take out your taxes and pay, send the taxes and all that, right? That's like, I think the easier way for me to be able to explain that for you. So now you've decided, you know what, I have the experience, I have some money and I have a nice size client base. So I'm going to open my own practice, or I'm going to be offering my own services on my own terms with my own company. Or I might work for a different company, but on a 1099 commission based performance versus a W 2. Well, a lot of times when you do that switch from a W 2 to a 1099, what ends up happening is now you're basically kind of resetting the clock for you in terms of being able to use some financing options to be able to qualify, right? And typically, you will need about 2 years, which will be more like 2.5 years at a minimum, depending on when you started, to show that you have enough of a steady income doing self-employed or being 1099 or commission only in order for you to be able to qualify for the amount of money that you possibly would need to qualify, right? But let's take the reverse, right? Let's say that you were doing 1099 or self-employed in this industry, the same industry, and you decided that, you know what, I'm tired of working for myself. It's not it's not uh, it's not a consistent income. Yes, I am flexible, but I need money to be able to have more flexibility. Whatever it may be, whatever that decision may be that you choose to do, that could be a lot easier for you to go from a 1099 to W2, and then to show that you've had at least a good couple months working and making your hours and working full time to be able to qualify. Obviously, other conditions apply, versus if you go from a W2 to a 1099 or self-employed. So those are the mistakes that I wanted to share with you guys today, because I want to make sure that you understand how these things can impact you as well. Okay. The other thing, not being honest on your application. Okay. That is very important. A lot of times people think, let me hide information from my loan officer and not let them, like we're not going to find out. So for example, what is one of the key information that people try to hide, thinking that we're not going to see it, right? So as a loan officer, when I ask you to submit your documentation, right? Pay stubs, W-2s, when you're working for like a W-2 company, tax return, if you're doing 1099 or commission, part of the reason is, well, we're going to have to submit it eventually to underwriting. But to start the process, part of the reason is for me to be able to truly assess, to see, okay, based on the information that you told me, right? Because I've had people who say, well, I work 40 hours every week. Is that the minimum you work? Yes, the minimum every week. Okay, great. So I'm all excited. Okay, because we're going to make this happen, right? Because you're getting paid, you're working every week, you're making 40 hours. I mean, we're doing this, right? It's great. And then I get the pay stubs. Well, when I look at your year-to-date pay stub, your year-to-date pay stubs paint a different picture, right? Your year-to-date pay stub shows me that you're averaging about maybe 30 hours a week versus 40 hours a week. So now I have to have a conversation. You've been averaging 30 hours versus 40 hours. Did something happen? Is this something that's going to continue happening? Because we need to talk. And the reason being is, I don't want to set you up for failure, right? I don't want to set up myself or you or the realtor that trusted me with you as their client for failure, right? So that's why it's important that when I review the pay stubs down, not every loan officer do that. That everybody have their prerogative, right? Me, I like to look at all the information from the beginning. And the reason why I like to do that is because I know that if I issue you a pre-approval, right? I give you a pre-approval. You pre-approve, hey, Mr. or Miss so-and-so, you're pre-approved for $300,000 or $400,000 or $600,000. If I give you a pre-approval and I tell you this is the amount that you're pre-approved for, and I've analyzed your income, your credit, and financial documents, I know unless something happens, a surprise, something that I didn't see, I didn't know, because sometimes it does happen. Unless something happens, we should be able to find you a home and have you close with those information, right? That's the point of a pre-approval, right? Pre-qualification typically is like you tell me and then I put it and I say, okay, based on what you told me, it's good. I like to do a pre-approval because I want to make sure that not only what you're telling me is good, but is being supported, because the underwriter is not just going to take my word for it. They want to see the documents that's supporting it. So now if I do a pre-approval and I look at your pay stub, and your pay stub, you're averaging 30 versus 40, we need to have a conversation. Why is that? What was there a circumstance that caused you, instead of having 40 average, you having 30 average, right? That's important. If it makes sense, then to show that, okay, well, now moving forward, you're going to be having 40, then, okay, we can possibly move forward with that. But if the situation is still the same, then it's better that I pre-approve you on 30, and maybe the underwriter may give you, some credit and it shows 35, versus I pre-approve you on 40, and now when the underwriter does it, it reduces your hours to 35 or 30 and not 40, because now you could possibly be at risk to lose the home that you really like. You're under contract, you spent some money, right? You've done the inspection, you've put your deposit down, you've done appraisal, you pay for all those items, and now for them to come back and say, oh no, sorry, you would need to either lower the price or get another home. That could be devastating. That could be very devastating. And that's one of the things that I work very hard to do in the beginning, is to get all the documents, so that way we could at least have the proof that yes, you've been making your hours and that you will continue to make your hours. And that is very, very important, because if that doesn't happen, then that could potentially cause you problems in the long run, and we don't want that, right? So the goal is to get you into your home. The goal is to help you build your wealth, generational wealth, with your own home, versus paying someone else's mortgage, right? So it is not a positive or win for anyone involved when, unfortunately, you are giving a pre-approval and now you don't qualify, right? So as long as we're doing our jobs the way we're supposed to do it, and you're being honest, because it's a two-way street, right? You're being honest and forthcoming about where things are, and based on the income and your credit, and you're also, following the instructions, right? You're not getting any new credits, right? Let's say together, I am not getting any new credit, right? You're not applying for a new credit card. You're not going to get a car finance, right? And whatever money that you show that you had in your bank account to be able to use for down payment or closing costs, you're adding to that, and you're not, subtracting from that. All these things are things that's definitely gonna be a positive for you in the long run. Speaking of money, it's also very important that you understand, if you're depositing large sums of money into your account that has no kind of document trace or anything like that, that's going to make it very hard for us to be able to use that money. We have to be able to show where that money is coming from, and to have a legitimate explanation. For example, let's say your company that you work for, they give you a check, right? The company that you work for, maybe it was direct deposit or a physical check, that could be traced back to that company. A lot of people receive their IRS money payment. Yay! Happy for you. So, if that money was deposited directly from the IRS website and into your bank account, that could be traced, right? You can pull up, you can go on their website, you can show where the amount of refund that you receive, and your tax document should be able to support that. We're good. But if you're like, well, I have this auntie, cousin situationship, and they decided that they wanted, to give me some money, and the best way you did it was you took the cash and you deposited it to your account, we might have a problem, right? So that's why we tell you That's why we tell you, when you are in the home buying process, welcome, thank you for joining. When you're in the home buying process, it's very, very important that you do not make large sums of deposit into your account. Let's have a conversation. Where's that money coming from? What does that mean? Because that could potentially affect, um, you know, it could potentially affect your approval. It could potentially affect you closing, right? So thank you so much for coming, for watching. Please share the live. So that's why it's very important. For example, there's nothing wrong depending on the financing type that you're doing. A lot of them allow for you to be able to receive gifts from family members, but it's how you're receiving those gifts, right? So that's why it's important that we have a conversation so we can know, okay, which family member and how you're receiving those gifts, and to make sure that you're not doing something thinking that you're doing the right thing and yet now you're putting yourself in trouble. So let me do a quick recap for the people who are joining me right now. Thank you so much. So today I'm talking about what not to do before buying a home. So avoid losing your approval, right? Um, Number one is opening new credit cards or getting a car loan, or new opening new credit cards or getting a car note, financing new furniture or car before buying, missing or being late on payments on whatever debt that you have. For example, credit card debt or student loan debt or car payment debt or any kind of debt that is on your credit. That's very important to not do that. Changing jobs. It's not necessarily a bad thing for you to change jobs, but depending on the type of job and how you're changing it, that could potentially affect your pre-approval and for you to be able to purchase a home. And then making large bank deposits without documentation. That could definitely affect you in your home buying process. So please try your best to avoid those situations. And as I stated as well, not being honest on your application. For example, if you're saying you work 40 hours a week, but in reality you're only working 30 or 25, let's do the 25. Let's do the 30. Let's see your documents. Based on your documents, I can say, okay, well, maybe we'll give you credit. Let's say you have overtime. We can give you credit for different things, but it's better that you're honest from the beginning. That way, whatever you're pre-approved for, it has documentation that can back it up. When I see it, when the underwriters see it, and you can get into your home and not be stressing, right? So thank you so much for joining me. If you're watching this live, say hi, type live, type home. Thank you so much for joining me, and please share this information because I feel like there are so many people that could benefit from the information that I just shared, and I would love for them to reach out to me, or for you to reach out to me if you have any additional questions. I am here for you, and I am so grateful to be able to share this information with you, and I hope that you did find value in this information and that you can use it for you and or your family or your loved one. Okay, so thank you so much, and I hope that you have an amazing day. Thank you for watching. Thank you for watching. I am definitely working on being more visible and sharing more information, because I talk to so many different people every single day, because that's what I do. I talk to clients. I help people with real estate. I help people with mortgages, and a lot of things. There's a saying, you don't know what you don't know, and a lot of the times people are making some mistakes that could be avoided if they had the information. So that's what I want to do. So please share this live. If you're watching the replay, type replay and share it, because I think that this will be beneficial to a lot of people and will help a lot of people, and hopefully get into their homes, keep their homes, and make their real estate dream a reality. Thank you, and I hope you have a blessed day, a blessed night, a blessed morning, wherever you're watching from, at whatever time you're watching. Thank you so much.